Welcome back to In the Harbor, the podcast where sports, leisure, and finance meet. I'm your host, Jason Johns, joined today by my co-host, Sean Richland. Sean, welcome back to the co-host seat.
Thanks, Jason. It's good to be back. It's been a minute. You kind of kicked me out for a while. I'm happy to be back here in the seat today.
Yeah, content was falling off, so we had to bring you back.
Thanks.
And today we're thrilled to be joined by Shana Sissel, founder and CEO of Banríon Capital Management, affectionately known across the industry as the Queen of Alternatives. And with her, yes, with your background of sports management and deep Boston sports roots, we feel like you're the perfect guest on the show today. Thanks for joining us.
Thanks for having me. I love talking sports. It's a chance to finally put my sports management degree to work.
Well, and being in alternatives, there's now a merging of both worlds.
There is, and you're seeing content like yours more and more. In fact, CNBC has entire episodic series called On the Record and Curry Inc. that are just dedicated to talking about the business of sports. So it's an exciting way for me to take both of my worlds and finally combine them.
Well, I'm a sports management kinesiology person as well from Michigan, and I fell in love with business from that program. And it is an amazing kind of leg into the real business world. I always found it to be fascinating how quickly you could jump from one to the other and how many similarities there are.
It's really just it. I'm sorry.
Did you find it? Did that happen to you as well?
I was actually about to say that. So I went to UMass Amherst, which in the sports management world is the Harvard of sport management. It's the #1 program in the country. And I always tell people when they say, there seems to be an assumption that it's a fluff degree, but it's actually part of the Eisenberg School of Management. Now, all the same core courses are required. So you still got to take, accounting, you still got to take financial statement analysis and calculus and statistics, and all your regular business classes. It's just when everybody else takes the second class jump that's more focused on their area of expertise. So whether it be international business or finance or accounting or whatever, you take sports classes. And those classes are actually quite interesting. The business of sports is far more complex than traditional business models. And I don't know that everybody really appreciates that.
Yeah, I would agree. There's so many different levels to it. Since we're hopping right into sports, I got to ask you, have you been following the private equity situation with the Big Ten at all? Has that been something you've been monitoring and looking into?
I have been following all of the private equity investing in sports trends since the last 2 or 3 years, where it became a big deal, and even more so after the NFL approved PE stakes and LP stakes in NFL teams. So yes.
Yeah, it's a big deal. You look at these. So the Big Ten specifically, there are the have and have-nots, in my opinion, in the Big Ten right now. And the lower-end schools want to take the money. The USC and Michigan have kind of stayed away from it. It's going to create a bit of a divide, I think, in the conference, and may end up creating a super conference. But it was like $2.6 billion that got offered, some crazy number.
Yeah, I think that the conferences themselves have to work in the best interest of the conference, right? Look, if Michigan or USC doesn't like the idea that they have to almost subsidize some of the other programs, then they should go the Notre Dame route, right? Like if you really want to have control over those things, then you go independent. That's why Notre Dame is independent. They don't want to be subsidizing a conference. And let's be honest, until recently, if Notre Dame had joined a conference, anything that came the conference's way in terms of media rights, licensing, anything of that nature would be subsidized by Notre Dame, because it would be like, if you want Notre Dame, you got to take everything else. I think the same is true with Michigan, USC, or whatever. But I also want to point out that some of those programs aren't as powerful as they think they are. If USC had as much cachet as they thought they did, then they would have been able to save the Pac-12. They wouldn't have to have joined the Big Ten. I just want to make that known.
I think that makes sense, absolutely. And then looking at the NFL, you brought that up real quickly. The interesting thing for me is if you're an owner of an NFL franchise and you want to stay as an owner, how did you ever find liquidity before now? You had to bring on more people and sell more shares, but now you have a chance really to create liquidity for your family, because a lot of these teams are owned by generations and there's 10 kids or 8 kids. So I think this is going to be a very prevalent thing in the NFL.
Well, I think it
Yeah.
increases NFL valuations too, because the reality is, and I spoke with a NFL team president, and what he was talking about is like the valuations are as such that if we don't allow private equity in, there's going to be no buyers.
It's exactly right. That's why you see ownership groups now, because it's I don't know how aware audience are of how these deals are structured, but professional sports leagues have limitations on the use of debt in order to purchase teams and to operate teams. So you can't use debt. You can't go to the bank, and plus banks wouldn't lend to a professional sports team because the structure of the operations is not inherently what a bank would want to see. They're not necessarily massive cash flow businesses, and they're not meant to be profitable. If you aren't spending every dollar that you have, then you are potentially leaving money on the table and losing the opportunity to make your team more valuable. So you gotta win in order to have your value increase. And if you're not spending money, then you aren't winning. And so there's some complexity to what is required when you go in and purchase a team because of the debt limitations. And so in many ways, you have to have ownership groups. And to your point, you have to be able to allow for some of these minority interests to be able to come up with the funds in essentially cash to bring to the table to purchase the team. It's just a requirement. But then on the flip side, there has to be a guy, right? The principal majority owner, because there has to be a decision maker on everything. It can't be a collective. And the leagues require that in order to proceed with an ownership opportunity. And so, again, they're approving certain individuals. They go through background checks. The owners vote on them. There's a reason why when we talk about team ownership, there's always like we talk about Jerry Jones or Robert Kraft. They're not 100% owners of those teams, but they are the principal owner, the majority owner, and they have control. The vast majority of control. There has to be a single controlling interest.
So how do we look at this from an investor standpoint to the accredited investor in America that might have access to this stuff now? They could be a small part of a small ownership group, but it does give you access to a different alternative that perhaps people never had access to before.
It's not just the opportunity to access investing in sports. I always call it ego investing, because a lot of times it's really just about telling your buddies. I don't remember the guy's name, but there's a guy who has an Instagram account, and in his bio he says owner of the Yankees, and I was like, I've never heard of you in my life. And I Googled him, and it turns out he's like a 0.005% owner in the Yankees, but he can say he's an owner in the Yankees because he is. And it's literally in his Instagram bio. And so there's almost like an ego bio thing associated with having an ownership interest in your favorite sports team. And you get access to certain perks as it relates. It doesn't matter how small your interest is. It's still an ownership interest, and you still get ownership perks, in terms of tickets, game day access, things of that nature, because you're an owner. So those things are kind of the perks on top of the potential investment thesis. But the vast majority of the big four teams are kind of at a maturity that the growth opportunity is not as robust as some of the emerging sports teams. So I would suggest to anybody who's interested in investing in sports, as in one of these sports focused PE funds, is to focus on the ones that have a diverse base. They all are going to have professional sports teams investments because that's like the sexy part. But you really want to think about somebody who's thinking about what comes next, like where's the real opportunity? And that's going to be in things like WNBA. It's going to be, there's whole yacht leagues, you have F1, things of that nature are going to be where you're going to get the greatest returns. It's not going to be in your NBA or your NFL teams by any stretch of the imagination.
Well, F1 valuations have skyrocketed from the Bernie Ecclestone days.
Yeah,
and
but
it could be the Netflix and the increased media. And
I was literally about to say that. I said one of the things with F1, and you're seeing it now happen with other sports, is content creation is king. It's what draws interest. And with more and more streaming services vying for media rights of sports because ad dollars are more valuable for live entertainment. And live entertainment's value is how you can get the eyeballs on during the live stream, right? Sports is one of those things that like no one will watch after. You know the outcome, right? You want to watch it in real time.
Sure.
No, there's very few people on earth that will be like, oh, I'll just record the game and watch it later. Like not in this day and age. So from an advertising perspective, it's the only opportunity you have to make sure people see your ads. Because if I record something, I fast forwarded through the ads. Like I'm not paying attention, right? If you're an ad tier of Netflix, when that ad comes on, you're looking for ways to like fast forward out of it, or like you go and start looking at your phone. You're not actually paying attention to the ads. So the value of the ad space is substantially higher for the live events, especially sports, which means the Netflix, the Amazons, the Apple TVs, of the YouTubes of the world need media rights to live sports to ensure that they can get premium advertising dollars. And then in order to also drive interest in sports that maybe are not, the big four highest profile sports, they create content around it. And F1 is a perfect example of content creation around a sport that actually drove interest in the sport. And I think you'll see more and more of that.
It's fascinating. I always look at it's just Savannah Bananas, banana ball. Like, how'd that happen? It was kind of like the Harlem Globetrotters of years ago. And it's all content.
Have you ever read the story about the Savannah Bananas?
I have.
How that like came to be?
I've read bits and pieces on the couple that started it, and they're amazing.
Yeah.
I probably don't know it as well as you do. So if you want to verse me on it.
I don't know that I know it like in depth, but to your point, it was a couple that bought like this minor league, like independent baseball team, couldn't sell tickets. Nobody cared. And so they decided like we're in a world. I went to a conference earlier this week and it was a capital convergence was what it was called, but it was mostly venture capital, private equity guys talking about, the next generation and what makes a startup successful and what they look for. And the thing that was mentioned time and time again is creator economy, influencer economy, where the next generation of successful entrepreneurs are going to be the folks that are content creators and that approach the business with that mindset. It doesn't have to be the base of the business, but understanding that the influence and the way that you reach your market, no matter what that market is through really understanding and leveraging content creation and the influence economy. And at Banríon, that's been a huge part of our go-to-market strategy because our senior executive team had a massive following prior to me starting the firm. And so we've kind of used that to, as I like to say, punch above our weight class and be seen on the same level as some of our much, much larger peers. But the way we're able to do that is by leveraging social media and that content influencer economy with our podcasts and YouTube, and just that type of thing is how we reach our audience and create those authentic connections. But it's how sports is doing it too. The reason why if you create content over, say, F1 is because people become connected with the individual players and now they're invested in their careers and their success, and that makes them want to watch and cheer for them. And when people feel like they are connected and have a personal connection with something, they're far more likely to follow that through and spend money and things of that nature.
Right. I think that's fascinating. And you think about some of the studies that have come out on what certain Gen Z or whatever generation we're on want to be when they grow up. And I saw one that was a poll, and I think it was 2/3 came back as content creator.
My son tells me all the time, so it's probably not the best sample because I'm his mom and his dad's also a content creator. He's a travel influencer. My son says all the time, like, I want to be a YouTuber. I want to be a YouTuber, Mom. And yesterday when we were coming home from school, I was telling him about a project I was working on. He was like, I want to be just like you when I grow up, Mom. I want to do exactly what you're doing. And the project is a content creation opportunity that I'm doing in conjunction with another firm, and he that's what he wants to do. So he creates his own little TikToks and stuff, and then he always asks me, "Will you post it?" And I'm always like, "Sure," but I never do. And he asks me and my ex-husband, his dad, all the time, like, "Can I have an Instagram account?" And when we say no, he like his immediate response is like, "But you have one, and you're on it all the time." And like you care about likes and stuff because we always are talking about like we don't want you to like have likes, like drive your self-worth and things of that nature. And he's like, but that's what you do. And yeah, but buddy, it's a business. Like it's different.
Right.
Like
Oh, that's funny.
and but yes, to your point, it's because that's all they consume.
And they're going to be way better at it than we could ever dream because they grew up with it. Like this is we didn't even have the internet, and we were in college. And now these kids, they're going to know it inside and out. They'll be fascinating how fast they achieve greatness into what they've done. But I'd like to get into a little bit of your career. You started at Morgan Stanley, is that right?
That's correct.
And
as a financial advisor,
you weren't in like a Sears building, were you?
I wasn't because I grew up on the East Coast, so I was working on the East Coast. When I started Morgan Stanley.
Okay, good. Yeah, and then there for a couple of years as a financial advisor, working with retail clients. So you've experienced that part of it, and then how have you evolved to where you are today?
So I started, as you point out, as a financial advisor. I realized really quickly that was not my favorite thing in the world. The job isn't. I think the general public thinks the job is one thing, and it's a completely different thing. I remember back in the day, there was like a trend. It was like what my parents think I do, what my friends think I do, what the public thinks I do, what I actually do. And it was always like not anything like what everybody else thought.
Sure.
I think financial advisors fall into that bucket. I think most people look at them as like trading stocks and building portfolios and doing investment. That's not the job at all. The job is all about prospecting, business development, and relationship management. And the job that I was back in the day was basically the boiler room, sit in the bullpen, and every morning my operations manager would tape up on like the wall, like how many people made how many dials. And it was like a little competition. And you got to make 300 dials a day. I think the numbers, because it was all a math game. And it's still a math game. It's just done differently. But it's 500 dials to get 10 meetings to get one client. And that's the math.
Mm-hmm.
And so that's all you do is prospecting. And then once you have clients, it's not about trading their portfolios. It's about managing expectations, relationship management. And almost all of the rest of it is like outsourced in the case of Morgan Stanley to investment recommendations of, corporate and the home office and the home investment team. And that's still the case today. That's why turnkey asset management platforms, TAMPs, and wrap programs are the vast majority of what advisors leverage for client portfolios. And I realized really quickly, I really enjoyed all the stuff that was being outsourced and none of the stuff that I was actually doing as a job. So I went back to school and got my MBA, and then I pursued a career going into more of the actual allocation and management of portfolios. Had to kind of sidetrack a little bit just because I didn't have any relevant career experience. So it was more like backdooring my way into it. But I did eventually end up on that track. But by 2007, I was working for Russell Investments, helping manage their hedge fund of funds. I was supporting the lead equity portfolio manager for equity-related hedge fund strategies in that sleeve within the portfolio, and did work in that kind of role as an institutional allocator, making investment decisions on a portfolio level for pretty much the middle of my career, and at several different stops along the way before moving and joining Orion, the big fintech company, in 2018. And at the time, I was tasked to build out direct indexing solutions and SMAs and manage them, and then also build out the TAMP. But my heart always belonged to alts. I just found them so fascinating. When I got into that world, it was right around the financial crisis. Lots of interesting things happening in the alt world, both good and bad. But having come from Fidelity prior, I had been sort of brainwashed that like anything in the alt world was bad. And as I got more and more exposed to it, I was like, wow, this is really fascinating and also super interesting and giving me lots of information about things that are happening in the market before it's happening in the market. I used to like to refer to them as canaries in the coal mine. And so I never stopped loving alts. And so I tried to stay in that space. And ultimately, after leaving Orion, I was just working with financial advisory firms, REAs, helping them build in-house alternative platforms and not liking what was out there in terms of solutions to kind of build out what the vision was. So I ultimately chose to start Banríon to build out what I felt was what was missing from the marketplace as somebody who is trying to use those resources to build things in-house. And that's kind of what led me to where I am today. So across my career, I would say there's two very distinct segments. It's the segments where I was working directly with a retail audience and advisors. And then there's a chunk in the middle where I was actually working on the institutional side as an allocator in the hedge fund space.
So in practice with what you're doing today at Banríon, if a lot of our audience is RIAs that watch the In the Harbor podcast, and in actual day-to-day, how does your strategy affect them and help them?
So the entire premise and the value proposition that Banríon was built upon was the idea of helping financial advisors scale alternative solutions for client portfolios. We know that the vast majority of advisors don't use alternatives. I know the studies that are out there say otherwise, but the studies are using a biased sample. For example, one of my major competitors puts out an annual white paper about the state of the alternative market and wealth management, but the entire sample is their customers. So when they start saying like 75 advisors in our survey use alts, it's like, yeah, well, they use your platform and you're an alts platform. So of course they do. And so when you look at the full landscape and universe of advisors that are out there, most of them don't use alts. But when they do start to use alts, it's always on the liquid side. And there's really wasn't a solution out there that kind of met them where they were and then went with them on the journey. And then when you did finally get to that point where you were really comfortable using alternatives and started looking at, you know, the more operationally due diligence heavy private placements and things of that nature, illiquid stuff, you realize that the vast majority of advisors weren't able to do in-house a lot of what was required in order to meet their fiduciary responsibility from the regulators.
It'd just be too time consuming from a due diligence standpoint. I mean,
it's not just the time consuming, it's having the expertise necessary to do it right. And that it was all of those things. Even the big aggregators don't have big teams and resources in this space, and they're outsourcing it all the time too. But ultimately what it came down to is the platforms that existed today were kind of looking at how to check the box so that they could distribute to those, but not really solving the problems of billing, reporting, held away assets, and third-party due diligence at an arm's length, meaning that doing diligence when you are incentivized to fundraise for the person you're doing diligence on is a conflict. And so advisors are not permitted to use that to meet their fiduciary responsibility. From a compliance perspective, they can use it as a jumping off point, but they still have to do their own work because the baseline that they're looking at is in conflict because of the revenue structure. It's just not meant to be objective. And so we wanted to provide that and provide an open architecture, open source way for advisors to like bring everything under one portal, one login, and also solve held away asset problems and things of that nature. So we really focused on building our value proposition around solving problems that we knew nobody was solving for the advisor, but were the primary reasons advisors were not allocating to the space. And then more importantly, I've always kept my advisor hat on and thought about like, what's the goal? Like, right, if you're an advisor, what's your business goal? Your business goal is to retain the clients you have, bring on new clients, and increase the assets that you manage. And so everything we do for the advisor is really focused on achieving those 3 goals. So we have a lot of business development, educational resources available to the advisor so that they can think of Alt as a business development tool. Our industry is more and more moving into a place where there's a lot of pressure on fees, and fee friction's a problem when you are like doing low cost indexing where your alpha opportunity is very low, and then you layer on fees on top of that. You got a lot of cost that gets associated with that, and that gets lost over years. Lost revenue opportunity, lost growth opportunities for your clients. And alternatives is really the place where you can justify a higher fee and generate excess returns that can mitigate some of the fee friction that happens along the way. So how do we do it? Because advisors aren't going to cap intro conferences, nor should they be. And so finding ideas, most of the platforms out there gatekeep ideas and treat advisors like they're children. And we wanted to treat them like they were adults who were smart. They needed information. We had the information to help them make good decisions. And we wanted to put them in a position of power again, where they were not the thing being sold. And more importantly, they were the ones that held the power to make the allocation decisions and decide who succeeds and who fails, not me.
And I think, a lot of your role can serve around education, both for the advisors and then how the advisors can relay that to their end clients. You think about just how misunderstood the alternatives universe is.
It's not just that. We spend a good chunk of our time educating asset managers.
How the advisors work and what they need. Yeah. It's a two-way street.
And setting expectations, because what's going on right now is that it's universal knowledge that the assets to be had are in the trillions in the advisor world. And it's a fairly immature world. It's still very much in its infancy, whereas the institutional allocation side is very much mature, and there's not a lot of extra dollars to be captured at this point. This is a massive opportunity. But what isn't fully respected or understood is what it looks like from a sales cycle perspective and a educational perspective, and what it means to be a fiduciary in an advisor world. And then also the other thing that I don't know that most people understand or really appreciate is how strangely fragmented the advisor world is. Like, think about it. You have fully independent SEC registered RIAs. You have dual registered. You have broker dealers. You have hybrids. You have bank trusts. You have OBJ. You have 3 different legal definitions that are all called advisors. So you have an SEC investment advisor representative, which is different than a broker dealer FINRA licensed registered rep, which is different than a FINRA licensed insurance agent advisor. And all 3 of and then you have your bank trust guys, which are different animals as well.
They all run their businesses so different.
And all the businesses are run completely different, and they all have different hurdles to even be able to invest in certain things. Like, the easiest ones and the flattest structures are the fully independent SEC only registered advisory firms who have discretion. The aggregators are a little harder because they're basically function like broker dealers, but some aggregators allow more autonomy than others.
Right.
And then some aggregators have different levels of autonomy.
But that's always changing too with the aggregators.
Exactly. So like, there are fully captive advisors who can't do anything without blessing. Then there are the kind of Carson made an investment in them, so they have some autonomy, but they still kind of have to follow Carson's rules. And then there are some that are just fully autonomous within the Carson network. So that's a good example. But it works the same way. probably, in my opinion, the most complicated of all of the major advisor platforms that exist, because it's like 7 different things. It provides broker dealer and services for bank trusts. Like most banks and credit unions, their advisors are platform advisors, and they have weird dual registered hybrids, fully independent, fully captive, almost wirehouse like advisors. And so that's the most complicated, in my opinion. And then there's also a difference in, if I'm an alternative asset manager and I want to sell to a aggregator or anybody who's just dual registered or fully independent SEC registered advisor, that process is pretty easy because there's not a commission-based aspect to it. But if you want to go broker-dealer, there's sales agreements. Now you have to build in fees to pay commissions and loads, and that's a different thing. And then there's also, you get approved on the home office level. That's wonderful. You spend 9 months going through all of that, and you think, oh my God, I am totally in the clear. My life is made because Morgan Stanley just approved me on their platform. But what you didn't realize is Morgan Stanley's not giving you a list of all their Morgan Stanley advisors. And you still got to go out and sell to each one individual, because Morgan Stanley's not doing that for you, which is a massive lift. So there's that. And so when I talk to asset managers, like helping them understand, like, look, I know you think this is going to be easy pickings. Like, look, it's a huge opportunity to grab capital. But most of them fail because they're not patient and don't understand that the advisor is legally obligated to check certain boxes, which requires time. And it's not 1 or 2 meetings and you get a ticket. It's like 6 meetings before you get an allocation. And at that point, it's 6 to 9 months down in the relationship, and you had to spend the time. And if at any point in time you aren't meeting the needs of the advisor or being proactive and being really accessible and on top of things, you'll lose the opportunity. And so I spend a lot of time explaining to asset managers, like, I like to say, I try to scare them as much as humanly possible, because if after they hear everything I said, they still want to go for it, then I know they're committed. Well, but the vast majority don't hear me when I say these things. And then when they start experiencing it, it's like, why am I not fundraising? It's like, because it's just not how it works.
Well, I think the simplified flat structure of the traditional RIA SEC registered has every portfolio manager thinking that's where their next area of growth is going to come from. Mm-hmm. But they don't really have a comprehensive plan on how to attack the market, to your point earlier.
Well, it is the simplest and the flattest and probably the shortest sales cycle, but it's not zero. So what that would normally look like is, if I have a manager who is interested in engaging with an RIA that's in that space, they're going to do an initial meeting. And then the advisor is going to need to do a due diligence review, right? And so they're either going to have to do it in-house. They're going to ask the manager to go get third-party due diligence by using, a number of providers that do that. And that is a $50,000 lift that the manager has to do. Like, it's not negotiable. And if they're doing it in-house, that's a 6-month process to get the whole packet done. So those are your 2 options. So that's your first hurdle. You've gotten the meeting, they're interested. Now we begin the due diligence process. Now, once the due diligence process is completed, the investment committee reviews the due diligence and then has to do a vote, right? And once the vote is done, say you're approved, then the advisors can go out and talk to their clients about the opportunity. And that may require at least 1 to 2 meetings, because they'll bring it up. The client's going to have questions. They might ask you to come on and do a call with the client to answer those questions. Then the client needs to determine like how they optimize it and how much they're going to allocate. And then you have liquidity budget conversations. So now you finally get the client to that point, right? Now you got to make changes to their investment policy statement. So now you got to get your compliance guy and your operations guy involved to make those changes to ensure that you're properly documenting and making the correct changes to the IPS in order to ensure that you meet the SEC's requirement, right? And then finally, now you allocate it, but now you have paperwork and there's a back and forth. And if you're not using some sort of optimized digital onboarding experience, which is something we do, that can take upwards of a month or more before you ever see a dollar. And now we're like 9 months in, and that is the easy route. So if you come in and you already got the diligence done, right? So now you can fast track through probably the longest part of that process, but you can't skip the rest of it. And you just got to be prepared for that. Plus, here's the reality is most of these guys come in and they're like, well, our minimum is $1 million or $5 million, right? And then they'll be like, well, we'll do a feeder. Okay. Well, feeder is going to make your operations more difficult. So you got to build that out if you do a feeder. If you don't do a feeder, you can't have a $5 million minimum. You can't even have $1 million minimum. Yeah, 500,000 is even hard. I always tell them 250 or lower. And the reason I say that is because if you think about the average mass affluent RIA, their largest client is not $100 million family, right? It's maybe a $10, $20 million QP.
Right.
Who maybe has 10% of their portfolio available for illiquid opportunities. So now $2 million to work with. And then they're going to have a diversified portfolio within
all
that
2 million isn't going to be in one strategy.
Exactly. At best, you're looking at 500K or less would go into a strategy. And so I don't like that's what you're dealing with. And so all of those things I like to have come to Jesus conversations with asset managers. Most of them will either not hear me and then start the process and experience what I told them about and then act like I didn't tell them. Or they just decide, oh, wow, that sounds like a lot of work. Maybe we'll hold off for a while.
So we lived your life that you just explained. We're on outside of being a podcast crew here. We also sell to financial advisors and RIAs. So we know that sales process, and it's hard. You got to stay on people, have those conversations, be available. And if you're not available, they're just going to call the next person in line. So there's a lot of hurdles to it. So it is a lot of steps, and I applaud you for I guess being so sincere with the new managers that come on and letting them know.
You have to tell them, but
role.
I also tell them, like, you need to know on an actual level what the process would look like to invest in your product. Because the number one thing I run into, especially with interval fund managers, is the feeling that, well, if I just have an interval fund, now I have a ticker and now I'm super easy to sell and super easy to invest in. But that is not true. Just because you got a ticker and you're on Fidelity does not mean that the advisor can just go throw your ticker into a trade and voila. There's usually paperwork involved that the advisor has to complete. And I always say, if you tell the advisor in advance, hey, in order to invest in our product, when you go to make the trade, Fidelity is going to prompt you and give you 7 things you got to fill out, right? Or that you need your client to fill out. And you got to make an IPS adjustment as well. If you tell them that up ahead of time, it's not a surprise. And so it won't be a roadblock. But if you don't, and then they go to do it and then realize there's like 8 steps they have to take, they're like, oh, come on, man, I'll do something else. It's all about setting expectations. But if you don't know that that's true because you never bothered to ask or even try the process yourself, open a Fidelity brokerage account and try to trade your ticker, like, then you don't know. And that's true with a lot of alts, even the liquid ETFs. I like to always say this. So one of my favorite products in the liquid ETF space is an ETF called BTAL, and AGF is a client of Banríon's. And so I have helped my sisters and my dad and my late fiance allocate their 401ks or IRA rollovers. They'll ask me, and I love, and I have BTAL in my own personal portfolio. But the thing that shocked me the most when I first, even myself, went to put the trade in for BTAL was that they blocked me. And I couldn't understand why. So any kind of ETF that's in the alt space that uses leverage or shorts or anything is considered an aggressive. So when you open your brokerage account, you have to fill out that risk questionnaire where you like kind of fall into a bucket. Right. And if you didn't fill out that questionnaire to be in the most aggressive bucket, it'll tell you can't trade it unless you make a change. And then you got to do the whole thing over again.
So you got to go back to your risk tolerance and then adjust it.
Yeah, and then adjust it. And then you got to sign something saying that you understand the risks associated with this product.
But how many people are going to do that once they
exactly.
block?
Forget it, I'm out.
Right. As soon as they get the block, they're like, oh, man, okay. And then they just move on. But that's my point. And that's an ETF. But if you're the ETF sponsor, an issuer, and you've never tried to trade your own ETF in your own personal PA, then you don't know that. And then you can't tell the advisor what to expect. And then when the advisor does it and that happens, they just move on. Anytime it's more of a hassle than you thought, you've looked for the thing that's less of a hassle, especially if you're an advisor and you have to worry about, having a regulator surprise review. And so that's just how it is. But if you know and you've tried to trade your stuff, then you can give them the preemptive talk and the pep talk and help them through it and be more hands-on. And that's I think the key. But I am every day surprised at how many asset managers don't grasp this concept. Even the big ones. My favorite fun fact, I'm going to ask you guys. Do you know who the asset manager that has the largest amount of assets in interval fund is?
Interval fund.
Who is the largest provider and largest manager of assets in interval funds? Do you know who it is?
I actually have. I venture it's one of the big boys, but Blackstone, BlackRock, one of the BlackRock.
I think it could be Blackstone, just with the B REITs of the world. And
well, B REIT's not an interval fund.
Oh,
it's a private REIT.
Yeah.
But go on.
I wouldn't even know where to start. My guess is it's probably an obscure manager that we're not thinking of.
Yes, because every time I ask this question, everybody says what you said: Apollo, Blackstone, KKR.
Yeah,
right?
Those were my next two. So,
okay. And I'm going to tell you who it is, and you're going to be like, "Oh my God, yeah!" But also, 5 years ago, had you ever heard of them? And you know who it is?
5.
Drum roll, please.
I'm ready.
It's
Go.
Cliffwater.
Oh.
You know why?
Interesting.
Because Cliffwater doesn't do anything but interval funds.
That's all they've ever developed. Yeah.
That makes sense.
Yes, that does make sense.
And interval funds are a hard sale to begin with, but if it's all you sell, you know how to sell them. But if your wholesaler is going out there and they can sell the ETF, the private vehicle, the private REIT, or an interval fund, which is a little harder, when they get any pushback from the advisor, they immediately pivot to the other stuff.
Yeah,
and
they're
they're never really selling your interval fund.
Yeah,
right,
but if that's all you can sell,
you're going to know the entire process that the advisor is going to go through, start
which is
to
why
finish.
Cliffwater is the #1 leading provider and asset manager in the interval fund space.
That is, we get asked questions all the time whether or not an interval fund is a good idea to bring to market from some of our partners and prospective partners. And, I don't know if we have a perfect answer for them because it does relate a lot to the question that you just brought up. And, it could be good, but are you going to sell it?
Right.
That's the real question.
Are you committed to selling an interval fund?
Yeah.
Are you going to have dedicated people that only sell your interval funds? Because if not, the big guys, go look at Apollo's assets and interval funds after they seed them. How much they raise after the fact. The only website out there that does tracking of interval fund issuance, registrations, and information is a very, very belongs in 1995 website. It's intervalfundtracker.com.net.org. You go there and you'll get 7 pop-ups immediately. But it's where you can find all this information. And you can see all the funds that are being registered, tender offer, interval funds, what's in the pipeline, where they stand in the approval process, and then what's out there. And you can sort them by assets and type. And it's it will surprise and shock you when you see, where some of those big guys stand in terms of what they've raised in their interval funds. You'll be really shocked.
It is really interesting. The whole package, what package you want to come out with now, it's changing so fast, and to keep up with it. And, the funds are going to ETFs, and then newer evergreen strategies as opposed to drawdowns. Do you have a sense in that, in what you're seeing? Does the evergreen strategy allowing a little more exposure to $25,000 limits versus a traditional drawdown, which doesn't have liquidity, as far as returns, as far as access? Does any of that, I guess, scare you?
So the one thing I like to remind people, and there was just a CityWire private asset summit where they interviewed a bunch of CIOs, and the number one thing that gatekeepers at RIAs are asking for is interval funds, but an evergreen private equity was what they said. And I just like to remind folks that the reason those funds are in drawdown structure is so they can get commitments to figure out what they can go out and buy, and then they call the capital when they actually have something to invest in. If you have to take the capital in, you have to be able to manage that cash.
Mm-hmm.
And how does that impact the decisions you make and what you invest in? Right? Because you can't be as patient.
Well, it's going to significantly. It has to.
Right. And not only that, but then you also have to always keep enough liquidity in the fund to meet the redemption requirements on the quarterly basis. Right. And so that is something that also doesn't exist in traditional private equity. So all of those things you have to consider.
Right. Well, there's a liquidity cost at the end
Yes.
of the day that exists, and that's okay if people want it. It's not like I'm not saying it's a bad thing. It's just, is it concerning with all the strategies that have come out in the last 5 years where we've seen massive growth? I think it's great. I think it's awesome that people can get private equity, private credit, private equity, and evergreen strategies. But all in all, it sounds like you've built a heck of a business, and your knowledge base is really strong in the space. We appreciate you taking some time with us today.
No problem. I could talk about this stuff forever. I'm sure we could go on for like 2 or 3 more hours if we wanted to.
We're going to do
the topics are fascinating.
long format, Joe Rogan style next time.
Yes.
Yeah,
4
I don't know
hours.
how much your audience will stay on for that long to talk about some of this nuanced stuff. But yeah, it's really fascinating. And I try to be, from my standpoint, my job is to be on the advisor side. And so I try to be as frank and transparent as possible about everything. I want you to know how hard everything is up front, because it's a lot easier once you've made the decision to move forward to make that decision if you know every obstacle that you're going to face, and you're prepared for it. And if you don't know, that's where things fall apart. And so by educating both manager and advisor and client, I think we'll have better outcomes and the retention to the assets, which is another big problem this space has.
Yes, nobody likes surprises or unintended roadblocks. But Shana, thank you very much for joining us in the harbor. It's been great having you. We appreciate your insight.
Thank you. I appreciate the invite, and hope to talk again soon.